Yo, what's up, everybody? It is Tuesday, November 22nd. Had a nice rally today. I'm sure some of this had to do with the fact that, it's just a quiet week. People traveling for Thanksgiving, probably markets are thin, but nevertheless, it was a good day in the market, and I kind of find it interesting because we actually had the last 2 days, Monday and last Friday, were net drains, fiscal drains of about 11 billion. 7 billion yesterday and 4 billion on Friday. So normally you would see a pause in the market, but we were really strong today. Indicating to me, or suggesting at least, that this is short covering ahead of the holiday. And it's a good sign. I mean, when we get a rally in following 2 days of fiscal drain, even though it wasn't a big drain, 11 billion, it's still a positive sign. Now, tomorrow we get a Social Security payment. That'll be the last one for this month of November. And typically, Social Security payment days are positive for the market, or at least like the following day is positive for the market. So we could see some extension of this rally, but then I think we probably see some pause, maybe a pullback on Friday and going into early next week. We still have December is a quarterly corporate tax payment. December 15th. I look back at last year, we had about 100 billion from like mid-December into early January, about 100 billion net drain from that. So that's something to keep in mind. The other thing to keep in mind is, and I mentioned this yesterday, is the debt ceiling. That has to be increased. Now, I don't think there's any immediate danger, even if that's not increased, because Treasury can rely on what they say extraordinary measures. They continue making the payments for a while. So I don't see any fiscal disruption from that immediately, but they got to get that done. Now, I see a lot of Wall Street people still forecasting a terrible 2023. Or let's put it this way. I see a lot of recession forecasts. And I just find this very fascinating because we have seen already 6 rate hikes this year by the Fed. And most of them were jumbo rate hikes, the 75 basis points. I think that like the last 4 were 75 basis points. So, and everybody knows that this year has witnessed the most aggressive rate hikes by the Federal Reserve since the late 70s, early 80s, the Volcker period. And yet we are coming out of 2 quarters of contraction. And we had positive growth in the third quarter, almost around 3%. And now the forecasts for the fourth quarter are above 4%. That's a very healthy growth rate. But I still see these people on Wall Street, these analysts, who a lot of them are very widely, highly regarded, I'm sure well compensated. This guy like Mike Wilson and others, got somebody at Bank of America and some other places, calling for a recession. And it's just, for me, I find it kind of odd that, they've been just doubling down on their recession forecasts, even as the economic growth forecasts are not only positive, they continue to be revised higher. So they're totally ignoring that. Like I said, we came out of 2 quarters of contraction in the first half of 2022, and I explained that was the result of an unprecedented reduction in fiscal support, right? 1.7 trillion, almost 2 trillion sucked out of the economy massive. You know, the administration likes to parrot this, and they like to trumpet this as if it is something positive. They say the fiscal balance improved by $2 trillion. Well, the reverse of that, which is exactly the same thing, if you state that the fiscal balance of the non-government, that's the economy, had the worst, contraction in history, at least from a fiscal standpoint. That's sucking out of $2 trillion. So yeah, it's totally understandable why the economy contracted in the first half, and those guys, who made the bearish calls on the market, I mean, they were right, but for me, they were right for the wrong reasons. It had nothing to do with the rate hikes. And I think that's proven in the fact that we have seen 6 rate hikes. Like I said, 4 of them recently have been jumbo rate hikes. And, the economy is showing accelerated growth. And this goes back to what I've been saying for a long time and what I've been forecasting, that, you're going to reach an inflection point where the negative impact from the rate hikes, which is that discount to financial assets, right? If you want to do net present value, that's cash flow. One of the variables is interest rate, and the other variable is cash flow. At the beginning, when rates start going up, there's that negative impact because that's immediate, okay? When the rates start going up, it takes time for the interest income paid into the economy as a result of those rate hikes start to compensate and add to cash flow, in the sense of, more people having money to spend, and that leads to higher sales and revenues, etc. So, they're not paying any attention to that, all right? They keep looking at the rate hikes, and I guess they're just ignoring the fact that economic growth is accelerating. And you could say whatever you want about that, but I mean, it's the way we measure it, and it's also the way that they look at things like that, like corporate profits is a function of economic growth, and it's also a function, actually it's the first derivative of government spending. I mean, that flows directly in many cases to corporate profits, some cases indirectly, but I mean, the government is a net payer. It pays vendors, it pays salaries, etc. So I mean, they're not paying any attention to that. So I just look at their forecast for recession, and they're really doubling down on this, and they're really, really adamant about this. And I mean, it's just like, dude, do you see that? We're coming out of first half of the year of negative growth into positive, and then accelerating positive, and you had 6 rate hikes, 4 of which were jumbo rate hikes. So whatever. Anyway, let me talk a little bit about this FTX. I saw an interesting interview on Fox Business. Now, I just, the full disclosure, I don't watch any of these business shows. It just happened to pop up on my, I was kind of perusing YouTube, and just like that popped up. Maria Bartiromo had on Jordan Belfort. He's, the Wolf of Wall Street, the original Wolf of Wall Street. I mean, Belfort ran a fraudulent brokerage operation for which he was convicted. He went to prison. If you want to know what's a fraud, I guess the best way to know is to ask a fraud, right? And Belfort is the expert on that, because he operated a fraudulent firm and went to prison. So he had some comments on the FTX and the Sam Bankman Fried situation, and I'm going to play that for you right now. So take a listen.
Joining me right now is the Wolf of Wall Street, Jordan Belfort, to weigh in. Jordan, it's great to see you again. Thanks very much for being here. How do you see the FTX collapse?
Well, first of all, I think there's some misconceptions here about FTX. People are referring to it as an exchange, but it's not an exchange. I mean, it's like a brokerage firm or a bank that was holding customers' monies, and they were basically siphoning it off. He was using it as his own personal piggy bank, Sam Bankman Fried. So people deposit their money in FTX because they want to trade, like any brokerage firm. It would be the equivalent of like you going to J.P. Morgan, right? And to Chase, right? And you deposit your money in your Chase bank account, and then you find out that actually Jamie Dimon has been taking your money personally and going to Las Vegas and gambling on the weekends because, your money, his money, what's the difference? So that's what was really happening. He was just using all of these funds that people were depositing in the brokerage firm, FTX, which is really a brokerage firm, and then using it as his own personal piggy bank. They bought condos, whatever else they bought. They're gambling on wild derivative trading, right? So they're leveraging to the hilt. So had to end badly, and it was definitely a fraud from the start.
That's unbelievable. That's a great analogy also.
So he really, like, he's a good communicator, you have to say. And I think he explained that so well. The analogy he gave that, like, okay, you put your money in Chase, and then you find out that Jamie Dimon, was taking your money and going to Vegas and gambling. It's like, oh, your money, my money, what's the difference? It's exactly what SBF, Sam Bankman Fried, that nerd was doing. Now the question is this guy gonna get punished for this? I mean, it's really incredible. You're talking about billions and billions and billions of customer deposits that he just blew out. The guy was, just like totally playing in the gambling in the markets, didn't know what he was doing, had some CEO or CFO, this girl who looked like a total nerd. They were all sleeping with each other at like a kind of a dorm room when they were all bunking together. It was just like incredible. And you had these institutions just, falling over themselves to give this kid money. Some of the most savvy Silicon Valley investment venture capital firms, some of the most savvy. I talked about Paul Tudor Jones. His company gave money to this guy too. I mean, unbelievable. But here's what I like the best. I'm going to show you a clip of Terry Duffy. Terry Duffy is the CEO of the CME Group, which I was a member of the CME, it's Chicago Mercantile Exchange. I was a floor trader back in the 90s. I traded in the S&P pit out in Chicago. I was living out in Chicago. Terry Duffy, very savvy guy. He's the CEO of CME Group, which is the largest derivatives business in the world, the largest derivatives exchange in the world. And I want you to listen to what he said. Very eye-opening. Take a listen to this.
I had a meeting with Sam Bankman Fried for the first time in March this past year. I never met the man. He asked to meet with me at a conference. And I sat down with him. I said, what is your end goal? He says, well, I want to compete with you. I said, great. I'm all for competition. What do you want to do? He says, well, I want to compete with you in crypto. I said, why would you do that? I said, I'll give you one better. How about if I give you my crypto franchise that's worth $30 million and we'll go from there? He says, well, what do you want? I said, you know what I want. Let me be your risk manager. I'll clear it to make sure it's done properly. He says, well, you won't deploy my model. I said, your model is crap. Why would I deploy a model that's going to introduce risk to the system? Of course I'm not going to deploy your model. He turned me down, flat out turned me down. And that's right away I said to him, I said, you know what, you're a fraud. You're an absolute fraud. You're supposedly worth $26 billion and you're an altruist. And I said, if you're an altruist at $26 billion, how come there's not a $10 billion donation going to somebody right this moment in time? How about a $15 billion donation? I said, you know what? I said, my net worth doesn't start with any B's. I'll give you 3 to 1 that I have more money than you. I said, I'll tell you what, I'll give you 4 to 1. I got more money in my right pocket than your net worth. I said, you're a fraud, and I'm going to make sure that we get this out there. And that was it. So we went.
So Terry, look, folks, I got to tell you something, man. You can't pull anything over on these Chicago boys. I was out there. I was out there at the heyday of, the floor trader days. the CME, and I remember coming there from New York, and New York was, you know, we had a great exchange down there at 4 World Trade Center. You know, I was a member of the NYMEX, I was a member of the COMEX, I was a member of the New York Futures Exchange, which was a part of the New York Stock Exchange. But when I went out to Chicago, I mean, that exchange out there and the Board of Trade, but specifically the Merc, I mean, that just blew my mind. It was so, you know, 21st century. It was just a marvel. It was something to behold. And those trading pits out there, as raucous and as wild, and New York had a reputation, and I always thought this was interesting because I remember guys coming out there from New York. I was one of them, and the Chicago boys were always like, oh man, that's a New York dude. Like I don't know, they felt like they were in competition, but they almost felt like they were a lower status. But I thought, you know, dude, all of the financial innovation, when you think about it, you know, derivatives, options, all of that financial innovation that really got going in the 70s, you know, with financial futures and stuff like that, and currency futures, and then the interest rates, and then the indexes, that all started in Chicago. Like, I'll tell you a story. Like, my first membership experience was on the New York Futures Exchange, which was that was owned by the New York Stock Exchange. I'm talking, this was 1980, folks. 1980, 1981, if I remember correctly, maybe 1982. In fact, we were on Broad Street, which we were physically attached to the New York Stock Exchange. Like, I could walk across a little like connecting tunnel from the knife and walk right into the New York Stock Exchange. And there was the New York Stock Exchange, the preeminent equities exchange in the world. Okay, I used to walk across, and you know, you had your specialist booths and stock, which these guys specialize in making markets for stocks. And you know, they did nothing. They launched stock index futures, the New York Stock Exchange index, and there you had, right next to us, and they owned us, the New York Stock Exchange, and their members did nothing to bolster or support the trading activity on the fledgling knife. Okay, they just kind of, you know, like disowned us in a way, like looked down through their nose at us. But Chicago launched the S&P futures. I believe it was even after maybe it was even after the knife launched their New York Stock Exchange futures. But Chicago, because there was a history of futures and commodity trading, they used to round up their members. Like, the leadership of the exchange would literally round up members, throw them in the pit, and say, support this contract, trade in there every day, give it liquidity. And I remember when I first went down to the knife, it was easy to make money. Like, I was an independent trader, and I was able to buy at the bid and sell at the offer all day long, like pretty much risk-free. I would make a market for the paper, the orders coming into the pit. In a very short, and I was doing really, really well for myself, and I was a total novice. It wasn't like I was some kind of genius trader or something like that. But in a very short period of time, that edge that I had, in other words, making that market, buying at the bid, selling at the offer, that disappeared. And the reason why it disappeared was because the business started to steadily flow to Chicago, and the liquidity on the knife dried up. And I bought a seat on the knife. In the early days, I paid $20,000 for that seat, that membership. And eventually, that went down to $100, and eventually it went down to $0. So that's what happened. Chicago knows how to do it. And it was very obvious when I listened to that clip of Terry Duffy telling this guy to his face, and I love it, he said, your model is crap. Okay, you're a total fraud. My net worth is not with a B, but I bet you 3 to 1 I got more money than you, and I bet you 4 to 1 I got more money in my pocket than your entire net worth. That's balls. And those guys are cool. Anyway, that's it for today, folks. I hope you enjoyed it. See you tomorrow. Bye.